Well, my next guest is optimistic heading into the new earnings season, which is just around the corner. He manages about $19 billion at Fifth Third. He's Mark Demas, joins me now from Minneapolis. Mark, nice to see you again. And you're optimistic because?
Well, for one thing, I think that if you look at the market, sentiment clearly is pretty poor. If you look at when the market started going down, there was really a dearth of corporate news, kind of in the April-May timeframe. So you haven't really heard from companies a whole lot. A lot of other clearly negative news has filled that gap. But at the end of the day, we think that while things are fairly cloudy out there, we think that once corporate earnings do start, revenue growth is going to be pretty good. We think that companies will somewhat, keep expense growth in check. And we think that what they had to say probably is not as alarming as what people expect to hear. So we think that in general, stocks are going to find a little bit firmer footing as we move through earnings.
Mark, it's John Erlichman. On the other hand, there are some who are still concerned that the expectations on Wall Street for earnings for next year are still too high and that it is not fully factored into the weakness we've seen in stocks right now. Where do you weigh on that?
We don't really dispute that. We think that the transition from a stimulus-aided economy to one that's not is going to be fairly uneven, and we think that's what we're seeing. We think that clearly data heading into the third and fourth quarter is going to be pretty important. But right now we think that sentiment is so poor that any good news right now is going to be met with buying, and that portfolio managers are going to be looking at their favorite stocks, looking to buy stocks.
The buying is going to be pretty sharp and lasting. How do you know that?
Well, I don't know if it's going to be very sharp, but I think that there's just going to be a lack of selling pressure on the market, and so when that happens, any incremental buying is going to send the market higher. And on average, we think that corporate news starting in about a week is going to be good enough to get the market to head higher. Clearly, we're going to be watching the housing numbers in the third quarter to see if that data can stabilize. If it can at lower levels, we think the market can continue to head higher. If not, the market may languish here.
Mark, it's Sheila Dharmarajan here. Two stocks that you like is McDonald's on one hand, a very, very defensive name, and on the other hand, Cummins Engines, which is obviously a very cyclical name. The connecting thread could be emerging markets exposure. Is that what you're looking at with these two names? Is that a big part of your thesis going forward?
Yeah, that thesis runs through both of those companies. With McDonald's, this company has really turned around, has executed very consistently for a while. We think that's going to continue. We think that investors are continually skeptical that McDonald's can maintain the momentum. So not only good sales in the U.S., but Europe and Asia Pacific as well. On Cummins, really, it's just that the truck market is turning, and that sentiment is positive for the stock. They also have great emerging market exposure and really early leading positions in truck markets where volumes for transportation for trucks is really surging higher, and they've got a great position there. So profitability for Cummins, we think is really going to be great over the next couple of years.
Yeah, in this market where you've seen so many stocks go down, it's pretty easy to see where there's good value. But Mark, what is it going to take to get some of the retailers to get back into this market? So we really do see a solid recovery here.
I think that retailers in particular could see is one of those areas that may not see any strength over the summer months.
No, but not the
retail
retailers.
Sales.
Not the retailers. The retail investors, I mean.
Oh, the retail investors. Well, I think that the headlines clearly have to improve for them to get back in the game, just internationally, for the European sovereign situation to improve a bit. And clearly you have to have the economy going. You have to be creating jobs. That's what's going to get the retail investor to feel good that there's some sustainability to economic growth. And clearly, we're not there yet. And so I would not expect the retail investor to be in the market anytime soon.
Mark, very quickly before we go, the bond market has a lot of friends these days. Some would say too many friends. Is there a danger for investors to stay in the bond market right now, do you think?
Yeah, we think that there is risk in the bond market. Clearly, the consensus on the bond market has been wrong. I think that the 10-year yields continue to head down a lot lower than people would have expected.
Yeah.
But clearly, it's just there's been a lot of demand for bonds.
Right.
Once the Fed starts to heads up that they're going to raise interest rates,
Mark,
you're going to see that reverse fairly quickly.
All right.